Good day, my name is Chris Stokes. I'm a FinTech entrepreneur and a development economist. I will begin, as any good economist would, by assuming that we are all clear on the critical importance of capital and the capital markets in the functioning of a modern economy through the provision of funding for investment and development. Allow me then to bring sharp focus to bear on how the coronavirus and its related COVID-19 illness has impacted the global and regional markets. Afterwards, I will explore the economic consequences of the pandemic's impact and make recommendations. As may be seen here, the spread of the virus has been exponential. The important point to note is the inflection point and the rapid growth in numbers of persons tested positive for the coronavirus. It is now in every continent in the world except Antarctica, and in practically every country, with the dubious exception of North Korea. Looking at the change in the major stock market indices globally from January 1st to March 18, 2020, we see where several indices started out the year well, but as the end of January approached, they started to show weakness. And by the first week of March, all went into a period of steep declines with no immediate prospects for recovery. Equally troubling is the decline in market capitalization of the largest global banks. Most are public companies, and their equity values will decline with changes in market values. The price declines also reflect a moderation in expected earnings from banks globally. Let us look more specifically at some of the major stock markets by region with a focus on the larger indices. We can see here, for example, where the Nikkei 225 essentially fell off a cliff starting in January 2020. The FTSE started a decline near the end of February and has not recovered. The DAX shows a similar steep decline and very tentative attempts at recovery. The CAC 40 shows a very similar profile. The profile of the Dow Jones Industrial Average follows suit. The downturn in the Dow Jones Industrial Average is made worse by investor sentiment. Here, we see that around 35% of registered voters in the US are less likely to invest in the stock market during the coronavirus. The pattern and trend of equity market collapses is also reflected in Latin American markets, where all have declined significantly. Bond markets too around the world have collapsed. As an example, we see where there have been unprecedented outflows for investment-grade bonds and muni mutual funds. The problems on the withdrawals and sell-offs are compounded by volatility in yields. The situation in these instruments has deteriorated to the extent where the US Federal Reserve has taken the unprecedented step of intervening in these markets. The central bank will now intervene in the municipal bond market with 3.9 trillion of price support, and it will now purchase fallen angel bonds from companies that have recently lost their investment grade ratings and has expanded its term asset-backed securities loan facility to include top-rated commercial mortgage-backed securities and collateralized loan obligations. Globally, bond yields have skyrocketed as prices have plummeted. The Jamaican stock market, which was the best performing in the world in 2019, experienced steep declines in March as a result of concerns about the pandemic. The Bank of Jamaica, for its part, concerned about the stability of the financial sector, has required additional stress testing of the banks. Thanks to capitalization efforts coming out of the 2008 crisis, the banks are well capitalized, but will no doubt come under threat from loan quality deterioration and declining returns from the capital markets. The Bank of Jamaica has also required that deposit-taking institutions suspend dividend payments as a means of preserving capital. The net impact of all this is that the flow of capital to finance investments and development, which are key, as we have seen, to fueling continued economic growth, has dried up. New investments have ground to a halt, and existing investments are at risk. Let us now take a look at the trade-off decisions that are driving this collapse. The public health approach aimed at curtailing or at least flattening the curve in relation to the spread of the virus has macroeconomic consequences which permeate into the capital markets and cause a downward spiral. In charting a way forward, we need to understand the interconnectedness of public health policies, its impact at the firm level and at the macro level, and the resulting effect on capital markets and investment for growth. The world is in fact facing three simultaneous shocks which have separate antecedents, but which have led to a synergistic worsening of the global economy. The shocks are the coronavirus pandemic, which has its own economic consequences, a collapse in foreign income because of a collapse in commodity prices, tourism, and remittances, and finally, the collapse in capital markets. Let us look a little closer at the collapse in foreign income as relevant to our economies. The fall in commodity prices has accelerated since the start of the year, which materially reduces income for basic commodity exporting developing countries. Oil prices have been hit particularly hard, going for a while into negative values. This is particularly bad for petroleum economies in the region like Trinidad and Tobago, and affects the near-term outlook for Guyana, which started oil production at the end of 2019. It is, however, expected that the lower prices will benefit the majority of countries that import oil in the medium term. This shock originates from disagreements among oil-producing states, primarily Saudi Arabia and Russia, but was exacerbated by reduced demand, particularly from China, as economic activities at the factory level slowed. Tourism has evaporated, which has dire consequences for countries in the region. By way of indication, consider that in Jamaica, tourism accounts for 34% of GDP and approximately 77% in the Turks and the Caicos Islands. For many countries in the region, remittances account for a large portion of foreign earnings, and in this regard, Haiti is featured. These shocks to the current account may normally be addressed by borrowings from the capital markets. Economies in the region have done that routinely over the years. The challenge on this occasion is that the collapse in foreign income is accompanied by a collapse in the capital markets. The option for fiscal stimulus in the region also is largely constrained because of debt levels and low or non-existent primary surpluses, which would have created some fiscal space. In the case of Jamaica, The decision has already been taken to access the IMF's rapid financing instrument, and in the case of the Turks and Caicos Islands, after years of balanced budgets and surpluses, the announced stimulus package will result in a budget deficit of over 100 million. It is unclear what further steps may be taken as the crisis deepens and extends. We do know, though, that fiscal stimulus will dull the effect of the shock as presented here graphically. The mother of all shocks, though, is that caused by the coronavirus and the predicament which it places governments in. The starting point is the decision to take measures to flatten the curve. The rationale for flattening the curve is to have fewer cases at any point and therefore avoid a swamping of the healthcare system and a loss of life because of a shortfall in treatment capacity. While it is not clear that over time, flattening the curve will mean less overall infections, it has the added benefit of buying time to develop a vaccine and improve treatment protocols. The problem arises in the measures needed to flatten the curve, primarily limiting human interaction, not only in social spaces, but also in places of business, and reducing travel, including air travel. These two together effectively stop productive economic activity. This shock starts with the destruction of demand at the firm level. The shock then leads to firm closings, spikes in unemployment, depletion of savings, and encashment of investments in capital markets. The demand shock multiplies as there is less and less spending and consumption in the economy. Under whatever scenario is adopted for dealing with the spread of the virus, that is, whether there are containment measures or not, there will be a negative economic consequence. The dilemma is that flattening the curve and presumably saving lives will lead to a deeper and possibly longer recession, while not taking any measures at all will result in a less severe recession, but a greater rate of infection and greater loss of life. By way of conclusion and recommendations, the COVID-19 pandemic represents the biggest test of the post-crisis financial system to date. The pandemic constitutes an unprecedented global macroeconomic shock, pushing the global economy into a recession of uncertain magnitude and duration. The global financial system faces the dual challenge to sustain the flow of credit amidst declining growth and to manage heightened risks. This exogenous shock has placed the financial system under strain. Downward revisions of expected economic activity and heightened risk aversion have led to a major repricing and repositioning in global financial markets. On the one hand, the providers of funding have an increasing preference for short-term safe assets. On the other hand, credit risks are rising sharply. As a consequence, the demands on the financial system's capital and liquidity have risen. Heightened operational risks are adding to vulnerabilities. The global financial system is more resilient and better placed to sustain financing to the real economy as a result of the G20 regulatory reforms in the aftermath of the 2008 global financial crisis. In particular, greater resilience of major banks at the core of the financial system has allowed the system to date to largely absorb rather than amplify the current macroeconomic shock. Those forms of market-based finance that contributed to the 2008 financial crisis pose significantly lower financial stability risks. Financial market infrastructures have functioned well despite the challenging external financial and operational conditions. Nevertheless, given the unprecedented scale of the shock, key funding markets experienced acute stress, and authorities needed to take a wide range of measures to sustain the supply of credit to the real economy and support financial intermediation. The actions taken have been determined and bold, including large-scale central bank liquidity support. However, continued uncertainty about the scale and duration of the economic impact of the pandemic continues to pose strains on the financial system. Internationally coordinated action to support a well-functioning, resilient financial system and a well-functioning and open capital market system remains a priority. In summary then, the perfect storm is upon us. We cannot now turn to traditional capital markets for support, as the economic underpinning of excess earnings, savings, and investment and growth are undercut at the very foundation. The strategy must be to save lives, if not from a moral perspective, then from a human capital perspective. Second, we must use whatever resources are available domestically and internationally to mute the sharpness of the recession. There will not be a zero-case scenario, but policymakers need to make sure that they can manage the cases that they do have, engage testing, institutionalize the new normal behavior in public, and continue finding new innovative ways to work in and engage in new treatment protocols as they become available. And when the time comes, seek full immunization of the population. The capital markets work. They work well, but they need people to be working. So let's focus on getting that right first. Thank you.